Welcome to the new Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. And we're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Welcome to episode 17 of the New Barbarians podcast. Today's Monday, April 21st. The podcast will hit platforms hopefully before you make your commute home tonight. Last week, the trade war continues. The market is still digesting statements from last Thursday when Powell expressed concerns about stagflation. Trump stated that he should be terminated as soon as possible. As far as we know, that has not happened yet.
Or is it even legal, Bill, to happen, which, as people call it lawfare, but the lawyers and judges are earning their keep these days, for sure, on that.
Indeed, and we'll definitely touch on a lot of the macro issues when Mark gives his scorecard in a few minutes. But just to recap last week, oil, gold, and Bitcoin were all up a lot. Oil was up as opposed to more recent weeks and over the last year even on rumors of OPEC withholding supply and renegotiation of the nuclear pact with Iran. Right, so Bitcoin and oil were up 7%, gold 4.7%, non-US equities were up 5.3%, and US stocks were basically flat. Despite extremely volatile daily gyrations, around 3%. But yeah, ended the week basically flat. And it looked like the equity market may have found a bottom, or, we've said this many times now where we think we've found a temporary bottom. And then over Easter weekend, the long weekend, the Pope actually happened to die as well, but today we are seeing another across the board sell-off.
Yeah, we'll let tie the Pope passing this morning and the sell-off later in the show, not to be too light near, but there is actually a little bit of a story to talk about there.
Cool. Today crude oil is actually back down again, and then recession indicators are back up. With continued anti-US dollar, US asset focus. The Nikkei is down 1.3%. Hang Seng is back up. So China is rallied, I should say, since they closed 1.6%. Europe, each of the indices is down around 0.5%. And then in the U.S., everything is selling off across the board. Dow, S&P, are both down 2.5%. NASDAQ is down 2.8%. And then the leader is the Russell, which is only down 2.3%, which we picked up on last week. The Russell wasn't down as much as the large caps, presumably because they don't have as much exposure to the tariff war as the large, multinational large caps. Today, both yield curve and credit are indicating potential issues. And as we spoke about last week, some of these indicators are abnormal. The 10-year is still climbing and the US dollar is falling today. And with that, I'll let Mark discuss the scorecard across assets and markets.
Great, thanks, Bill. Yeah, there's a lot going on, and that listing's in order because we definitely had a week that looked like we were coalescing into a a bit of a calm, but that broke over Easter weekend. Certainly fanned the flames. Trump fanned the flames a bit by ramping up his terminating Powell discussion, which obviously is, I think there's a clause where you could remove a Fed chair for cause, and whether he's going to try to make that case public or through the courts, we still don't know. But regardless, we saw a big reversal. And even since we prepared for this show, I don't know, 45 minutes, an hour ago, we're now down almost 3.25% on the S&P. NASDAQ and S&P dropping further. And with it, even Bitcoin rolled over. Bitcoin was up. Let's look at the changes here over the past 5 days. This is through 12/25 Monday, April 21st. So just 45 minutes ago. Let's focus on the last 5 days. Safe havens, Bitcoin and gold, the only real standouts. As Bill said about oil rolling over, still over the last 5 days up 3.7%, because today was a big mover down in oil. Still up a little bit over a trailing 5-day basis. And then with only foreign equities leading the charge there. That was our statement last week, was basically global commodities last Thursday through the close that Bill was talking about. Those were the only assets that were really up, along with maybe some foreign equities. Gold, oil, Bitcoin, foreign equities. And that's also the month-to-date theme. So when you look at year-to-date, you're seeing about 1,200 basis points of outperformance by Bitcoin, still down year-to-date with other risk assets. And even as we speak, folks, and we're focusing on this because this is going to be the test for Bitcoin. If we hit recession, it'll be the only, you can call COVID a recession, I guess, but it was about 34 days. And no one in the service industries was really affected by it since their assets went up in price and few lost their jobs. If we do have a recession, given it's a tariff-initiated recession, there will be unemployment. And that looks like, I'm going to switch right through, pardon the quick flip here, but we're going to go all the way down to our GDP indicator. The Atlanta Fed has a GDP now. And as you see, on February 28th, it dropped dramatically. And the reason it dropped was because of exports. People in the U.S. imports goods as well as gold. And gold actually was over 50% of the decline. So what we have right now is data in green that went sharply lower because of more imports, people pulling forward goods, gold and other goods, into the U.S. to avoid tariffs. And then the blue line are Wall Street analysts slowly coming down to the reality of the data. From a 2.2% expected quarter to a 1% expected GDP in Q1. That was the last week of March. Until you look at April 17th, when you have now, I think it's about a 50 basis point Q1. So call it a coin flip. Getting very close to the negative GDP that the data that the Fed imports. So,
and then sorry, Mark, on can we actually see Liberation Day there? Is that what those two spikes down are?
So
right
Liberation, so April 2nd is right here, but the movements, Bill, I think you bring up a great point. All these movements happened before Liberation Day because they were corporate and financial firms driven. Financial firms imported gold ahead of the tariff, so they wouldn't be hit with a whatever tariff was going to come from whatever country. But then it eased up. Why do you think it eased up? Because they stopped importing goods after Liberation Day, even though the tariffs were not in place.
And should we expect this to flip over then? Nowcasting's interesting because it looks like all of a sudden this just happened, and clearly that's just when they got their information and plugged it into the model. But if multinational firms were front running the tariffs, that makes perfect sense. That's like a month before, or a couple, just say like the months before it actually came into effect. But shouldn't we expect that to then flip over when I guess they front run inventory, they'll sell it,
So that's the
kind of
point,
realize.
is they will sell it, but if they say they doubled up on inventory, they're not going to get the revenue for those cost of goods sold until down the line. So they're going to pull
Right.
through, however, they account for the cost, whether they, leverage it or whether it's on credit, however they purchase the goods. There's no revenue for that.
Right.
Because demand's not going to be higher by any stretch. So
even if it did flip back, what we see here is -3, and even that spike down is getting closer to -4% GDP. It's not that much, but it's somewhere in between. It went from above 2% to -3 like overnight. So
yep,
the slowdown in GDP is unknown even from a nowcasting perspective.
it's variable for sure, Bill. And you're right. It moved quickly. This is still new technology. There's not a lot of data. We went back to, I think, 2014 with one of our reports looking at it. And this is the sharpest move since COVID. And at a minimum, it's uncertainty. And that's been the battle cry of every strategist hiding behind numbers that don't fit work or jive with the price action in equities, is uncertainty. And you don't even have to know, folks, where the data comes from. But let's just say that the green line comes from analysts at the Federal Reserve of Atlanta looking at metrics that are provided daily, weekly, hourly. Let's just say that. So say it's 10 people, got a bunch of good computers. And the blue line are the top 10 and bottom 10 average forecasts from Wall Street. That's it. Those are two boxes. They're starting to converge. So you can say they might converge closer to the blue line or closer to the green line. But either way, it's close to or below zero. And that's not in the public consciousness right now. We're still thinking of a positive quarter. And what I think today's data of today's price action shows, Bill, is people giving more weight to a below zero quarter. And that's the takeaway. That's why I want to kind of focus on this one chart right here. I moved it to the back. I wasn't even going to have it, but I think when you start talking about recession and the price action, the sharp moves, I think it's more about impact of tariffs and how we can't unring this bell of imports and basically earnings destruction by companies. It's not free that they did this. There's a cost to it, and they're going to pay it. Yeah, back to the scorecard, because we talked about markets and equities, but the currency markets are the ones that are flashing red. They flashed red first across everything. And as we said, in one of our previous, we're at what, number 17 now on our podcast?
That is right.
So when, our audience is a heavy asset manager audience, and a lot from, Bill, your compatriots on the quant side, a couple of my markets folks, and we tend to be very narrow. We're in a field. We're a credit specialist. We're an equity specialist, maybe even a macro person. But then macro has tools that are limited and aren't as refined as, say, someone who's running earnings models based on quarterly upgrades. So we all have a specialization. So from my macro toolbox, and being a risk manager, the thing that got me to ring the bell and get everyone in the room to have a discussion early and often was when a low volatility, highly levered asset like investment grade credit, which was a signal in '08, mortgage or corporate, or currency crisis, which obviously tied back in 97, 98, and we'll have a chart that actually touches on that. When those assets that are supposed to be normally performing and not petulant, when they move, the world shakes. And so what you're looking at here is the US dollar having pretty sharp and unusual moves versus the rest of the world. And, April 2nd, this is day 19 of Liberation Day. We are still digesting what's happening in the marketplace. It took weeks before the government acted in '08. It took, the Fed now is hamstrung, which is why we think we're going to have problems going forward. Last Thursday, Jerome Powell, who's looking at all this data, including the inflation data, which we'll touch on in a second, and the declining growth data, and the destabilization in the markets, look at the currencies, and he's like, I can't really move. We're watching everything. We think the economy's in a good position, so we don't have to ease. We think markets are functioning. We had a great auction last Thursday. Didn't talk about the one that wasn't too good. So we're not going to act. But he did mention we have to be alert to the potential of inflation as growth declines. Those two dynamics. He thinks, and this is what a big point, which he's hanging his hat on, that, Trump is trying to put his hat in his hand and have him walk out the door. But the thing that Powell's stating that the data indicates that the tariff impact on growth has also had an impact on prices. Now, that's what he's hoping, that obviously it's not stagflation, but it's a classic recession where everything goes down, jobs, earnings, prices, and then the Fed can come in as oft times before, cut rates, Bob's your uncle, and off to the races. But that may not be the case.
So just to talk about the US dollar, it's weakened 9.5% year to date. That's inflationary, correct?
Say that again.
So the USD is down 9.5%. It's weaker against other currencies. Wouldn't that mean things are more expensive?
So weaker dollar for imports would mean that, we're going to be importing inflation. A weaker dollar could be exporting deflation. You would think, and maybe that's part of the game we'll talk about later about China. But at a minimum, there's going to be a shock bill, because back to the point about when companies are going through their strategies, they don't account for 10% changes in currencies.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support. Right. It seems like the mechanics are all over the place. But part of what I was wondering is, monetary policy, you pump the economy full of dollars and the US dollar should weaken, right? That's, part of why it's inflationary.
So if we increase the money supply, yes, we're going to be exporting inflation. What's happening now, though, is other countries are doing it. Germany's increasing their fiscal policy. China's doing
and
it.
the ECB reduced rates last week, right?
Yes. And then we're holding off. But the problem with that is, look at the ECB cut rates, I don't know, 2.5, 2.25, I think, in the target rate. We're still at 4.5. So we should be getting flows as our rates are higher. We should be attracting flows. We're not attracting flows because we're an unknown entity right now with the tariff play going in, that if flows come in, they don't know if they can get them back. We're trying to push flows away and weaken our dollar for sure. But the
Right. So
problem,
weak dollar, you should see people buying the 10-year, and we're seeing the opposite.
with a weak dollar, well, I would say it's the other way around a bit. Well, it could be that way. Is that I look at it as demand for flows, and rates attract flows. Everything else being the same. But I think what you're talking about, not everything's the same right now in the world at any stretch.
Yeah.
And that this is almost when market levels don't reflect value or future value because of the variability. Look at last Thursday to today. And that's when people just hold back, pull back, and certainly there's a strike on U.S. assets. And that was the point about, the Thursday's data you went through about global commodities, gold, oil, foreign equities, up 5 to 7% last week, Thursday to Thursday. And U.S. equities flat to down. It's a strike. And let's just go through some data. This is a kind of a how we got there on a month-to-date basis. I like this because sometimes seeing abstract, month-to-date data doesn't really show you. This is oil. Oil went down early from April 2nd to like, oh my God, what's going on? Liberation Day. Let me get out of the way. Oil sank, 13% in a day and a half, 2 days. Then it went sideways, kind of rallied, as you said, for because of some foreign policy dynamics. And then today it's like, you know what? I don't like what's going on in recession again. And dollar down 6. But look at the trajectory up in Bitcoin and gold. So rates of change matter. Second order derivative. People were going into these 1.6 and $22 trillion assets. Together, they're less than $25 trillion. And there's almost, how much on sort of liquid assets floating around, equities, rates. Let's call it $300 to $400 trillion. So these are small vessels, gold and Bitcoin. So it doesn't take a lot of flows, and we're seeing it. So I think this might be I don't know what's going to pop as a good graph. This might be the most instructive graph as a barometer of investor sentiment out of U.S. recession concerns into safer havens, Bitcoin and gold up the most month to date.
And then down the most are NASDAQ, the dollar, and oil.
And oil. Yep. And then just to give some people who like names, I know we do a lot of macro here. There are value plays out there. And I know, on the factor side, Bill's been talking about the performance of different factors. Duke Energy, that's the safe haven. That's the gold of the equity world. It does have a dividend, but stable. Johnson & Johnson also, even Deere, contract. We gave it that green color to kind of remind you about what we're talking about. And then Monsanto, ExxonMobil, less so, JP Morgan, outperforming the tech-heavy S&P and NASDAQ. So that's the lay of the land. There's dispersion going on. So this is a great time for hedge funds to be involved in the marketplace, which we'll follow up in a later episode. I know that, Bill, I think you're going to the AIMA Digital Asset Conference. There'll be a load of hedge fund managers that both trade crypto and TradFi there.
And sorry, just to reflect on one more thing. I remember thinking that the DeepSeek news was insane for NVIDIA. That looks like chump change now. And I saw, I think they had a $5 billion charge that they announced last week.
I don't think they took the charge. Maybe they did. They said it's going to be a hit. So, and the only reason I'm bringing it up is it happened so fast, Bill. I don't think their accountants had time to go through the data to actually
Yeah.
make it a charge. That's how fast it was. But you're right. Yeah, Trump said, I don't know if it was the something 80, SD 80.
Yeah, I think they can no longer export certain chips to China.
Right. Yep. I heard a podcast over the weekend, the All In, where they were, Chamath was talking about it, saying that each time a chip for NVIDIA was put on the do not ship list because it was deemed to be, not weapons grade, but that's my term. And it was say it was the SD 100, then they made an SD 80 that had maybe one less or 2 nanometers wider, bandwidth, something like that. So not as fine tuned. Then that came on the list for whatever reason. Then they went one step lower. So this was a one step lower, and they said $5 billion. And you're right. So here, Bill, what you're talking about, I think, is in January up here when we had that 17% decline.
Yep, that was on a Monday.
And then now, I mean, it's just a great example about how idiosyncratic risk can hurt. But when the whole world, goes on a 10 to 245% tariff markup, it can really impact everybody. So this is the part why I think the markets are shutting down, because it's what Powell hinted at, Bill. It's the black line is where Trump entered office. He entered office, overnight funds 4.5. That's a Fed funds rate. That's the one that Trump wants Powell to lower. That hasn't changed, obviously. And then the front end, the 2-year 430, not that much difference. And then you had an upward sloping yield curve as inflation was a concern. That's what you had. Then before Trump announced the Rose Garden Liberation Day rates, tariff rates, you had a rally. We call this Besant's report card. Besant was doing pretty well. The 10-year was, as low as 386 at this print on April 2nd. It was 420. But the purple line now reflects today. And the 10-year is up 20 basis points. But look at the long end, which is an inflation indicator. That is above Trump entry levels. That's why Powell was talking about, I'm not going to lower rates. I can't lower rates because I think inflation's a concern, that tariffs may have an impact on prices, that we may not have the expected degradation in price that goes along with lower demand. We may have sticky prices. So that's what this shows you. And, back to like the bigger problem that hasn't been priced in yet, Bill, is credit spreads. So this graph looks at high yield that, let's say high yield is somewhere around 8% yields. And investment grade bonds are about 5.5. So it's like 250 basis points or so. That's the difference. High yield has to pay 250 basis points more to get money than investment grade companies. Makes sense. That spread used to be as low as 140 before Liberation Day. Let's go over here. This is a historical trend. It's come down. This is the 02-01 crisis into the default cycle. This is 08 when things obviously were breaking. This is the European Greek almost bankruptcy. This is the deflationary spiral started with China's devaluation, oil scare from like 106 down to $24. And then credit spiked, and then we absorbed it, rolled back over. Now let's go to this chart. This is the last 5 years. This is what matters. Everything else is history. It doesn't matter. We're in a different world. Look at in the last 5 years, the periods of credit spikes. This was because of the Trump tariffs in 2017. This is when Powell, again, we spend almost too much time on the guy here. This is when Powell Bill said, I'm not going to touch rates. I'm not going to pivot. That was in December, I think, maybe November of 18. In December of 18, the high yield market shut down. There were issues that couldn't get launched. And then on January 3rd of 19, Powell pivoted. That was a famous Powell pivot. And he did it because credit spreads were starting to blow out and the credit markets were seized up. And Wall Street cried uncle.
So that is a preemptive pivot.
It was preemptive. It was preemptive to a default cycle. Yes.
Yeah, which is, Trump is he wants preemptive cuts, but last time Powell waited until he saw that.
He has to be invited and pulled into a movement. He cannot give an indication that he initiated it. And so just like, hair of the dog, you're going to need a little more juice to get you over the line this time. So it's not going to be just a high yield seized market. Maybe it's not even going to be 3 or 4 banks. Well, let me not tell you the story here. COVID, obviously, one of the fastest pivots on the planet, March 23rd of 2020, when they said, I'll buy everything on the planet, including credit. That's what caused this. This is the credit spreads to come down. And then you had the spike here between July and October of 22. This is when Liz Truss was forced out of office because the pound was flailing, gilts were for sale, and you had your UK pensions had to be bailed out by the central bank. I mean, so then Yellen came in and gave support. It wasn't Powell, but it was Treasury, gave support.
Wasn't inflation in the U.S. crazy?
Yes. That was the 9% number in the second half of 22, if not first. Yeah, I think second half of 22. So inflation was higher and credit spreads blew up. And then you had the bank failures in 23. But I just mentioned this because look at the spikes. The major spikes were all addressed with intervention. Well, here we are, folks. This is the biggest spike we've had since COVID. Rate of change, not the level, but rate of change. It's already started to come down a little bit, but I think it's going to be higher today.
And yeah, like I'll always say this, these are the observable transactions in credit as well, right? So high yield bonds, but we know there's a lot of private credit out there that's probably in trouble and not getting mark to market and not obviously being bought and sold.
Absolutely. Yep. And the high yield market's 1.5 trillion liquid market. I think it was that big 10 years ago. I don't think it's grown a bit. Names have fallen off. But the new issuance, as Bill, you're saying, has been, from the private equity folks who now opened up a new shingle and are now private credit managers. What can go wrong?
So, and sorry, so now we're going to get off into some territory that I love to talk about, but I'm certainly no expert. We're looking at high yield bonds over investment grade. Some people look at spreads over, government bonds. I like this because it gives you an idea for what people are demanding for junk, versus in U.S. investment grade corporate credit. But if we were to look at the impact of interest rates on the high yield bond market, there is a sensitivity there, right? And in your previous slide, what I saw was, the yield curve steepened quite a bit. And that usually is a good sign, right? Like, but now it's not.
It could be a good sign if they call it a bull steepener, which means that if, say, you have a flat yield curve, in a bull steepener, it means that the front end is bid and yields go down. And that means that, inflation's easing. It means that Fed may be easing, thumbs up, good for credit. But what we have here is a bear steepener. Back end was rising. That means
Right. And
Powell's
so,
not moving and inflation's setting in.
and I guess we're seeing yields going up in high yield. But yeah, the risk premium went up versus the 10-year, which is up, so basically like you can get a decent return with government bonds. Maybe people don't love them, but relative to high yield bonds, people are just demanding more
Yes.
compensation.
Yeah, and this graph inoculates for the Treasury as well because it's yield to yield. So it's Treasury plus spread, one minus the other. So,
Oh, okay, got it.
so for all intents and purposes, it's kind of the spread of one versus the other. Close
Right.
enough,
Okay.
as I
Yep.
say, for government work. So yeah, so there's definitely, to your point, more investor demand for risk premium. What does that do? That just increases costs everywhere. And if people are looking at more premium bill, they're not buying like it's YOLO. They're waiting. So the pace of investment declines. Pace of investment doesn't go up when someone's saying, let me see, should I buy the investment grade or the Treasury or the high yield? When you see that bull steepener where the front end's coming down, people are grabbing the highest yield they can before it becomes low. So there's an acceleration of investment process. It's an easier day to be a broker in those days. It's not now. It's slower, it's thoughtful, and there's the risk of loss is put at the beginning of the process, not at the end.
The other thing I noticed was I think there's more curvature in the yield curve. And that's where we're getting. I remember doing some research on the rates in the yield curve, but usually, there isn't as much change in the curvature. You'll see levels and the slope change, but this is a deeper drop in the short end versus the long end going up. It's just, it's steeper and I think more curved. And it's striking that this has happened over, a 20-day period.
Yep.
There's one thing versus when he was elected, but just over the last few weeks, this is moving a lot.
Yep.
I like this chart.
Yeah. And it shows you that from inauguration day, the front end has come in. Now, people think the Fed controls the 2-year and in. I think it's 1 year, but say the 2 years. So let's just say that. Now, you can't move the Fed funds rate. Literally, you can't. That's governed by the Fed. Banks can't lend each other at 5 or 4. It's 4.5, give or take. But the 2-year, the market kind of can do whatever they want there. Investors drive that. So it's influenced by the Fed, and the fact that it's come down pretty steadily and remains down on to today, it means that people are concerned about a recession. They think a rate cut will happen, but at the same time, there's inflation on the long end. So this is way nuanced, and I think after Powell's comments, the July cut went off the table. So I'm kind of surprised that the front end is this low, given we're not expecting a cut. But, again, when you look at 6 months, it's what? It's like 420. It's barely off of the 4.5. So, I guess this is in keeping with expectations of a recession, because people would be very comfortable if it all hits the fan and goes sideways fast on the economy. I'd rather be in a 1 year and 2 year, and that's where the demand is. So this is a demand curve, and people are running to the front end, trying to get some yield locked in for a year or two, while they have this wave of uncertainty flow over them, and they sure don't want to be in the long end here, Bill. That's what that shows me. And I know we don't show many charts on this, but since you're going to the who's sponsoring the conference?
AIMR.
So AIMA is it's a digital asset focused conference, right?
It is, yes.
So let's end or before we go back to you. I wanted to sort of share. There's this firm called New Hedge. I've been using them. I like them because they use on-chain data as well as off-chain, like exchange data and ETF flows, to kind of give you a combined view of external demand and on-chain dynamics. And this is a classic 200-week moving average. I don't do technicals a lot. This one I used during crypto winter to get some confidence and support, knowing that the system wasn't broken, to gauge demand. And I mention it because in December of 2022, it's when you had the biggest move below the 200-week moving average. It's tremendous support. And then when it gets to like 5 to 8 times above it, right now, the 200-week moving average of Bitcoin is about 45,000. Bitcoin's at 87, 88,000. So that's like a 2x. When we look at these types of elevated numbers, they're anywhere from like 5 to 11 times the 200-week moving average. So we're not that far ahead of it. I still think it's a reasonable entry point, technically speaking. I'm not here to sell Bitcoin as a entry point or not. I'm here to share an idea, an opinion. But more importantly, that there's data out there for you to make your own opinion. There's a load of information that's unique, and it's one reason why the conference that Bill's going to is getting more attendees than, say, last year, because people are looking for alpha, and there's certainly a lot of data asymmetry when it comes to crypto and Bitcoin as well. Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
I need to correct myself as well. It's AIMA. R is the reporting arm of the American Investment Management Association.
Okay.
The Alternative Investment Management Association.
Yes.
We just get so used to the acronym. And so the purpose of that is, discussions about alternative investments in crypto. And one of my former, my former boss actually is on a panel there. He works at Numius now, and that's how I found out about it on LinkedIn. Interestingly, I do have more comments about crypto this week. Usually I'm talking about factor returns and equities, but I actually have the Wolf Research report in front of me, and it's interesting that similar to what we've seen in equities, like what I'll just call safer cryptos, the large caps. So, think Bitcoin versus altcoins and stuff like that have been outperforming. And I think that would be the comparison to digital gold. So safer crypto assets are outperforming. Low vol crypto assets are outperforming. Highly liquid are outperforming, and then momentum has been getting crushed. And yeah, momentum and reversal both had a bad week. And I think that that's just because of the volatility. So momentum's, 30-day factor return for momentum in crypto is down almost 18%. And reversals down, 4%.
Hey, Bill,
So I think that
on those, on
yeah,
the momentum, that's probably looking at, we don't know exactly, but like the top 30 or so, or basket of coins and tokens.
that's right.
So if we know that there's been a narrow breadth. I mean, some coins like Solana's had a good run a little bit till today, but if there's a narrow breadth, that would impact, because Bitcoin's been an outperformer. So if there's that separation, then you would see momentum diminish because it wasn't broad.
I think that's correct. I believe their index is more than 30.
Okay.
But yeah, it would be the investable crypto
Yep.
universe. So maybe it's like 200, I think. But as far as breadth goes, yeah, I think it's a broad based, and I'm not. Yeah. So exactly, if breadth is wide and momentum is down, that means everything's selling off. And I believe that has been the case. But if Bitcoin started to reverse and the rest of the market is either slow or hasn't gained the momentum, it'll take weeks or like the next month for us to start seeing that.
Got it.
So yeah, that'll be interesting to look at week to week. But interestingly, they keep track of sentiment as well, and sentiment in cryptocurrency is definitely on the upswing. And all of everything I'm seeing is telling me that crypto is actually holding up to its promise, and it is, first of all, an asset class. And that's why, there's this conference about alternative investment managers investing in crypto and what different products are out there and how to manage risk. And I was hoping to get a paper out that I'm working on as well on quantitative crypto investing. I got held up over the weekend. Basically last night I started back testing some strategies, and momentum in particular. First thing you kind of test with crypto is technical indicators. That's where you see all of this sentiment driven buying and selling over the years, and crazy price action. So I got sort of bogged down with some back testing, and hopefully I'll get that out soon and basically share Python code where people can start playing around with this themselves.
Yeah, don't give that away, Bill. We do have a business to run. All right, let's paywall that.
Yeah, my all my research has been free, and this type of thing I actually do believe is pretty valuable because I know the amount of time I've spent on it. I've basically collected all of the research I could find over the years in crypto across practitioner research, including like Wolf, and academia. And then I'm synthesizing everything that I think works based on their various findings. And then, basically plugging it into a model and seeing if it works. But it has been extremely time consuming to gather all this data. And you hear me talk about how much I love AI and LLMs, but over the last few days, you've probably heard me, or you've probably seen texts and messages from me that are cursing them, and they are so powerful and such great tools, but that last mile of research is very, very expensive. I've been saying that this paper and this research was 80% done for a long time now. And then it was 95% done going into the weekend. And now I think I'm at, 95.5% after spending several hours, like a long time on this. But anyway, that's all just elaborating on my belief that it is an asset class. It is a place where you can systematically invest. It remains to be seen by myself. So my own independent back testing needs to just be proven out before I feel comfortable publishing this paper. But what I'm seeing from places like Wolf that already have their research platform set up and basically have these weekly indicators, especially given the macro backdrop, it's telling me that this is maybe not a safe haven asset the way gold is, but it is behaving a lot like the digital gold, because it isn't going to be subject to whatever happens when Powell cuts rates, or depending on how bad these preemptive economic policies get. We do expect the devaluation of the dollar, and you just see that coming through equities. And I think we've argued quite a bit that the 10+% returns in equities are inflated by inflationary policy. And I'm maybe not quite as much of a believer as you, being a huge Bitcoin bull, but I'm starting to see things that certainly make me think twice. And I've already been investing in crypto and trying to systematically do it and get my own emotion out of the trading. But Bitcoin in particular, being a store of value for the long term, is a very compelling story for me right now, especially because it is limited in its total possible supply.
Yep.
So maybe look forward to that, and then I'll let everyone know how the conference goes next week. Hopefully I'll be able to share my research, get a bunch of questions, give people a free notebook this time, and then we'll look at how to kind of monetize our research over time and put something like this behind a paywall. But for now, it's literature review of everything I could possibly find on systematic crypto investing, and then I'm going to provide a roadmap to do it yourself.
Nice. All right, with that, let's wrap it up before the equity market drops further. I think we started maybe with a 2 handle on the day, and I believe NASDAQ is now down 3.6%, S&P down 3.3% at 2 o'clock in the afternoon on Monday. Hope you enjoy the ride home, and maybe go to that. Well, you can't go to the conference. I hear it's full that Bill's going to, but I do notice, Bill, on the momentum side, just eyeballing my screen, that all assets in crypto, Bitcoin and the alts, are down year to date, every single one. But a lot are up month to date. I would say 75% are up over the last 5 days on my list
Wow.
of 30. I can't say that about equities.
No.
So it's coming to a store near you, folks. Hope that, look forward to reading your paper, Bill, along with everyone else. And until next time, subscribe, hit like, share. We're getting shorts out to you to make it easy to eat on our podcast before you dive in for the full meal.
Yeah, maybe take a look at our YouTube videos, instead of staring at the screen of everything going down for a few minutes, might be more lighthearted than talking to your coworkers about how bad things are.
All righty. Peace and cheers, everybody.
Thanks a lot.